All right, Ben Powell is with us, Chief Middle East and Asia Pacific Investment Strategist at BlackRock Investment Institute. Ben, good morning. Good to have you with us here. Thanks for your time. So the tariffs are finally taking effect. Now that they take effect, I think the next question is going to be how long will they be around for? Because these tariffs are essentially with regards to, they're not tariffs, at least that's not what's been stated. They're not tariffs to raise revenue for the US. They are to stop the the flow of drugs, illegal drugs into the US, right? Fentanyl, etc. So it's for a specific purpose. So you think they'll be around a long time, or resolution will be found?
Good morning. Yes, a historic day, actually. I think unusually we can have a clear moment where we move from one paradigm to a different global economic paradigm, and that's today. So the tariffs, as you say, go from theoretical to real, so they are here. To your critical question as to whether they're going to persist, but the honest and real answer is we don't know. And even the specific tariffs you're referencing towards Mexico and Canada, seemingly to do with the fentanyl crisis in the US, there's no clarity on exactly what Canada and Mexico need to do to kind of get tariff relief. Rumors are that President Trump is watching deaths specifically in the US, but that's not confirmed. So it's an extremely uncertain situation. So are the tariffs going to hang around? We don't know, which is the uncomfortable answer. And I think it's that uncertainty which is something that we do know. So we don't know exactly if the tariffs are going to persist in what numbers, but the tariff uncertainty for sure is already weighing on sentiment both in markets and economies. And I think that is that uncertainty is a kind of permanent change, which we're all going to have to kind of get used to as investors in the months and even years ahead.
Absolutely, Ben. Never a dull moment, I think, since President Trump took office, right? But while you're absolutely right, I agree with you, there's no way to know whether these tariffs last, whether they get changed tomorrow, who knows? But if you work with what we have right now, which is, say, 25% Canada and Mexico, and now 10 plus 10, which means 20% effective additional tariffs on China, if we work with that, then are we looking at a very real possibility of a growth slowdown, higher inflation in the U.S.? Because that's something which will be very tangible. And that's, I think, something that's beginning to worry the market.
Yes. So I think, look, this is now a stagflation shock, moving from theoretical to real. Interestingly, the market, I think, for now is very much focused on the growth element, which is not wrong, but I worry it's incomplete. So the growth impacts of a tariff conflict, I mean, Canada have already said they're going to retaliate. President Trump and his team have said they will retaliate to the retaliation. So we are potentially, right at the beginning of this kind of tit-for-tat escalation. So that is going to give everyone the heebie-jeebies. You would expect to see less spending, people kind of reining in, whether you're a company or an individual. People are nervously going to put incremental money away for a rainy day because it very much feels like it's raining. So the negative growth impacts is going to be real, and that's where the market has been focused. So as I say, that's not wrong, it's just incomplete. This should also be inflationary. So if we are imposing just a pure cost onto the construction import of everything, then prices should go up. And I slightly worry that the market is less focused on that, less aware of that, but that should come. So yes, it's kind of a double negative, unfortunately, of a stagflationary shock. For the moment, the market is kind of focused on the stag bit, the slowing growth, which is really important. But the inflationary problem is likely, very likely to play through. And by the way, that might give the Fed much less room for maneuver. There's kind of a hope, or maybe the Fed can save the day, do some cutting and sort of support the growth outlook. That is not obvious to us at the BlackRock Investment Institute, because they, like everyone, are waiting for the inflationary impacts of tariffs, which should be significant. And sadly, another kind of consequence of this tariff new paradigm, which we have entered as of midnight this morning.
Ben, give and take everything. Tariffs, probability of Fed not going ahead and cutting. How do you approach global equities? I recall that you were quite positive on US equities, particularly the AI-focused companies. And the Japanese market as well is something you liked. How are you approaching global equities year on, give and take everything, all the various factors at play?
Yeah, so we're still constructive. I would say a couple of things. Firstly, clearly, as the facts are evolving in real time, so are our thoughts. So we're still, like everyone, seeing how this plays out and the consequences for global markets. That's the first thing. The second thing, I do think this different paradigm requires more selectivity from investors. So during the good old days, the great moderation, when the kind of economic, geopolitical, even market volatility was quite low, you could be so-called risk on, right? You just were long risk. I think it's a much more complicated situation now, and we as investors need to be much more targeted, much more specific in exactly what geographies we like, exactly what sectors we like, and exactly what themes we like. So I would say this is a time, sadly, we're all going to have to do a lot more work and be a lot more picky in exactly what areas we want in our portfolio and those we don't. You highlighted a couple. Artificial intelligence, we still think is a huge deal. Japan is totally different kind of domestic corporate governance story, but they are examples of the kind of cherry picking approach that we at BlackRock think is just necessary as part of a much more fractured, complicated investment landscape.
No, absolutely. Ben, in the first term, President Trump, by the way, the S&P is still just about under 5% away from all-time highs. So if this is the beginning of a correction, in the first term, he would wake up many times, tweet about how the Dow is looking strong. I mean, so equity markets being high was a big kind of a point of pride, right? I'm assuming that is still the case. Although this time there is another feature. Does he want equities higher, or does he want cost of borrowing lower, what is the measure to gauge success? Is it lower yields in the US, which of course is happening, or higher equities?
So firstly, I think the market is working with this assumption. So just to make explicit a very important point that you made almost in passing there, which is the idea that he is constrained to some degree by his sense of greatness. He wants to make America great again. It's not exactly clear what that means, but it probably doesn't mean a recession or the equity market kind of collapsing, right? That doesn't seem consistent with his desire for greatness. So there is a hope and a reasonable argument as to why he is constrained by the equity market, which I guess allows us to somewhat sleep at night. Our concern, though, I guess, is if he really pushes through, if the US administration really pushes through with a tariff-first kind of policy approach, he might get neither. You were saying, is he looking for equities higher or yields lower? Stagflation, if we look, there's a lot of steps here, but if we go all the way through to stagflation, that's bad for growth, that's bad for earnings and bad for equities. It's also bad for inflation, meaning higher, meaning rates higher. So we're not there yet, but I must admit, I'm a bit concerned that if we are looking at a world of more and more tariffs, tit for tat, uncertainty will be higher, growth will be lower, inflation will be higher. And again, that's just bad news prospectively for equities and for fixed income. We feel President Trump and his team around him are, of course, brilliant people. One may or may not agree with their politics, but these are very sophisticated people. So there's a hope and an expectation that they fully understand this. And again, this is more of a hope. We don't know, but there's a hope that there is some kind of constraints imposed by the market and by economic data, with the overarching desire from the US administration for greatness not being consistent, one would have thought, with an equity market kind of maelstrom. So let's see, but that's the hope, I guess, that we're all working with in markets for now.
So Ben, finally, to wrap all this up, where does one hide? It's a very complex world, right? I mean, equities, there are issues. You discussed some pockets like maybe AI. Obviously, people are piling into US treasuries and bonds because that's a traditional safe haven. But I don't know if that will really sort of work given the stagflation scenario that you described. Basically, for the next couple of months, what's the best hiding ground?
So diversification continues. Sorry to give the normal strategist answer, but we should all be conscious that time in the market is important rather than timing the market. So as best we can, let's try to stay invested, try to stay well diversified, and try to stay more active in our investment kind of approach. So artificial intelligence, we continue to believe in, let's say, the story, and then a few cherries we'd be picking would include Japan, China as well, by the way, and a few others I won't go into here. Just this overarching point. Let's all try to stay focused on what we really believe. It's so difficult at the moment. We're all going to get, or the risk is we all get whipsawed around like tweet by tweet, which is dangerous, I guess. There's a risk there. We're all chasing our tails. So try to stay anchored in what we are really going to say high conviction on. That would include artificial intelligence, as you mentioned, but more broadly, a more specific, a more active approach to investing we think is necessary in a more complicated, more fractured geopolitical and economic landscape.
All right, Ben, we'll leave it there. Thank you very much for your time. Great speaking with you, and look forward to our next one. We'll tell